Ladies and gentlemen, Archivist here. I want you to do something for me right now. I want you to open your trading app. Pull up the chart for XAU USD spot gold. What exactly do you see? If you're looking at the COMEX feed from New York, you see red. You see a market that looks tired. You see a price that has pulled back from the all-time highs of December. You see a chart that screams correction. The mainstream financial press, Bloomberg, CNBC, the Wall Street Journal, they are all telling you the same story today. They're saying the rally is over. The Trump trade is fading. Real rates are rising. It is time to take profits. They are showing you outflows from GLD. They are showing you hedge funds reducing their net long positions. But I am here to tell you that the number on your screen is an optical illusion. It is a ghost price generated by algorithms trading paper contracts in a server room in New Jersey. If you want to know what is actually happening to the global supply of gold, you have to look 8,000 miles away. You have to look at the streets of Mumbai and the vaults of Shanghai. Because while New York was selling, something historic happened in Asia over the last 48 hours. A signal flashed that hasn't flashed in 2 years, the premium flip. As of this morning, January 4th, 2026, the world's two largest gold buyers have stopped asking for a discount. They have stopped waiting for the dip. They have started panic buying it over spot. The correction you see on your screen isn't a sell-off. It is a handover. The West is selling paper. The East is draining the physical. And today I'm going to show you why this specific flip is the mathematical proof that the floor is in, and why the next leg of this rally won't be driven by the Fed, but by the frantic desperation of the Asian street. To understand the violence of what just happened, you have to understand the boring mechanics of the physical gold market. Most people think there is one price of gold. There isn't. There's the spot price, the paper benchmark, and then there's the local price, what you actually pay to hold a bar. The difference between them is the premium. For the last 2 months, November and December 2025, gold was hitting record highs. The price was vertical. And because of that, the Asian buyer went on strike. The aunties in China and the jewelers in India said, "Too expensive. We will wait." Demand collapsed so hard that gold in India was trading at a massive discount. Dealers were selling gold at $60 below the international spot price just to move inventory. That is a bearish signal. It means the physical market is saturated. It means there are no buyers. It is usually the sign of a top. But then the calendar flipped to January 2026. The paper price in New York dipped just 2%. And what happened? Did the Asian buyers wait for a lower price? Did they hold out for $2,800? No, they attacked the market like piranhas. In roughly 72 hours, the Indian market swung from a negative $60 discount to a positive $15 premium. That is a $75 swing in sentiment in 3 days. That doesn't happen because of seasonal wedding demand. That happens because of fear. It happens because the jewelers in Zaveri Bazaar know that the supply chain is broken. They know that if they don't buy now, even at a premium, they won't have metal next week. Now, why does a $15 premium in Mumbai matter to a guy trading options in Chicago? Because of arbitrage. Gold is money. It flows to where it is treated best. When gold trades at a discount in India, the metal stays in London. It stays in the vaults of JP Morgan and HSBC. But when gold trades at a premium in India, a massive vacuum pump turns on. Right now, as I speak, bullion banks are chartering flights. They are buying paper gold in New York, suppressing the price, taking physical delivery in London, melting the 400-ounce good delivery bars into 1-kilogram kilo bars, and flying them to Switzerland. From Zurich, they are flown to Dubai and Mumbai to be sold at that $15 premium. This is the Western drain. Every time you sell your GLD shares because the chart looks weak, a refiner in Switzerland thanks you. You're providing the liquidity that allows them to feed the Asian beast. The chart looks weak because the West is liquidating, but the price won't crash because the East has set a hard floor. Western hedge funds can short the paper market all they want, but they cannot print physical bars, and eventually the vaults in London get empty enough that the lease rates spike and the paper game ends. But the story gets darker when we look at China. In India, the buying is driven by the people. In China, the buying is driven by desperation. Look at the Shanghai Gold Exchange, SGE. For the last 6 months, the SGE has consistently traded at a massive premium to COMEX, sometimes $40, sometimes $80. This is the China spread. It exists because the Chinese government restricts gold imports. The demand inside the golden cage is higher than the supply. On January 1st, 2026, a new variable entered the equation, the silver export ban. We talked about this in previous dossiers. China just banned the export of strategic silver. But the market reaction has been a flight to gold. Why? Because the Chinese public sees the export ban as a signal. The government is hoarding resources. The currency is about to devalue. So the Shanghai premium didn't just stay high, it expanded. Despite the price dip in New York, the Shanghai price barely moved. The Chinese investor is trapped. The stock market is volatile. The real estate market is dead. Crypto is banned. Gold is the only exit door left. And when 1.4 billion people try to squeeze through one door, the price doesn't care what the Federal Reserve does with interest rates. This brings us to the core thesis of this video, the handover. We are witnessing a transfer of wealth that happens once every 30 years. In the 1970s, the West sold gold. The Middle East bought it. In the late 90s, the West sold gold. Gordon Brown's bottom and the smart money bought it. Today, the Western boomer portfolio is liquidating. They are selling gold to buy tech stocks. They are selling gold to buy Bitcoin. They are selling gold because inflation is over. And who is on the other side of the trade? The Indian grandmother, the Chinese factory owner, the Turkish merchant, people who remember what currency collapse looks like. They see the US debt spiral. They see the weaponization of the dollar. And they are thanking you for the discount. When you see the premium flip, it is the market telling you that the weak hands are finally out. The paper speculators have been washed out. The physical accumulators are stepping in, and historically, this is the launch pad. Look at 2013. Look at 2020. Every major bull run began with a flip to premiums in Asia. It is the springboard. The price compresses, the physical market tightens, and then boom. The paper shorts get squeezed, and we gap up to $3,000. But there's one player we haven't mentioned yet. We talked about the retail buyers in India and China, but they are small fish compared to the whale that just woke up. While the Indian citizens are buying grams, the Indian government, the RBI, is quietly executing a strategy to buy tons, and they aren't just buying gold. In the last 30 days, a strange anomaly has appeared in the Indian import data. They are importing massive amounts of silver, record amounts that defy industrial logic. In the next section, I'm going to show you the RBI protocol. I'm going to explain why the Central Bank of India has suddenly decided to corner the silver market alongside gold, and why this double-barrel accumulation is about to break the London silver fix. We talked about the citizens of India and China buying gold to escape the dollar, but they are just the passengers. The pilot of this plane is the Reserve Bank of India, RBI. For decades, central banks only bought gold. They ignored silver. Silver was too volatile. It was poor man's gold. But in the last 60 days, a strange anomaly has appeared in the Indian import data. India isn't just importing gold. They are importing silver at a rate that defies all historical logic. In October alone, India imported $2.7 billion worth of silver. That is a massive jump from the previous year. Why? This is the RBI protocol. The Indian government has realized something that the Federal Reserve refuses to admit. They realize that silver is no longer just a precious metal. It is a strategic energy metal. India has a goal to install 500 gigawatts of solar energy by 2030. To do that, they need millions of ounces of silver paste for the photovoltaic cells. They know the global shortage is coming. They know the mines in Mexico are struggling, so they are effectively front-running their own industrial demand, and they are doing it using a brilliant geopolitical loophole called SEPA, the India-UAE Comprehensive Economic Partnership Agreement. This is a trade deal signed with Dubai that allows India to import bullion at a reduced duty if it comes through the UAE. Western investors ignored this deal. They thought it was just about jewelry. They were wrong. This deal has turned Dubai into a massive vacuum cleaner for Western silver. Here's the flow. 1. London vaults sell silver to Dubai refiners. 2. Dubai refiners recast the bars into India good delivery standards. 3. The silver flows into India tariff-free or low tariff under the SEPA quota. 4. Once it enters India, it never leaves. This is why the COMEX inventories are draining. The metal isn't vanishing. It is moving from a financial vault in New York, where it is rehypothecated 100 times, to an industrial vault in Gujarat, where it is consumed by a solar factory. The West is trading paper. India is securing the atoms needed to build the 21st century. But the most terrifying part of the RBI protocol isn't the solar panels. It is the currency. There are rumors, unconfirmed but persistent, that the BRICS alliance is looking at a new trade settlement mechanism. And unlike the euro or the dollar, this mechanism requires commodity backing. If India holds 880 tons of gold and thousands of tons of strategic silver, they have a seat at the table. If you hold U.S. Treasury bonds, you have a promise from a bankrupt government. The RBI is swapping promises for assets. They are selling dollars to buy metal. And because the silver market is so small, much smaller than gold, This buying pressure is acting like a hydraulic press on the price. Every $1 billion India moves into silver pushes the price up 10 times more than it would move gold. Let's go back to the solar angle for a second because this is where the squeeze hits you. You might not care about Indian central banking, but you care about the price of electronics. India's solar mission is aggressive. They are building gigafactories. These factories must have silver. They are price inelastic. If silver goes to $50, they buy. If silver goes to $100, they buy. Because without the silver, the $1 billion factory is a paperweight. This creates a floor under the silver price that is far more powerful than any speculator. When the price drops, Indian industry doesn't sell, they restock. This is why the dip you're waiting for will never happen. Every time silver hits $30, a purchase order from a solar company in Mumbai clears the order book. So, we have a retail population paying premiums for gold. We have a government cornering the market for silver. And we have a trade deal, SEPA, that facilitates the transfer of wealth from west to east. But what happens when the West wakes up? What happens when the investors in New York realize that the vault is empty? In the next section, I'm going to show you the COMEX break. I'm going to explain why the paper shorts are about to face a delivery crisis that will force them to settle in cash and why that moment will mark the true decoupling of the physical price from the paper price. We have seen the Indian retail buyer paying premiums. We have seen the Indian central bank front-running the silver market. We have established that the metal is moving east. But this leads to the most dangerous question in finance. If all the metal is leaving London and New York, how is the COMEX still functioning? To understand the answer, you have to understand what the COMEX, commodity exchange, actually is. Most people think it is a store where you buy gold. It is not. It is a betting shop. It is a casino where banks and hedge funds bet on the direction of the price. For every 1 ounce of physical gold sitting in a COMEX vault, there are roughly 100 to 500 ounces of paper gold traded in open contracts. This is the fractional reserve secret. The system only works because 99.9% of traders never ask for the metal. They just trade the contract for cash profits. The banks rely on this. They rely on the fact that you are too lazy or too poor to stand for delivery. But what happens when a whale like the Reserve Bank of India or a Chinese state bank enters the casino? They don't want cash profits. They don't want a check. They slap a delivery warrant on the counter and say, "Give me the bars." This is where the cracks are forming right now. We need to look at the inventory reports. The COMEX splits its gold inventory into 2 categories, eligible and registered. Eligible. This is gold stored in the vault, but it is private property. It belongs to an investor. It is not for sale. Registered. This is the gold that is actually available to be delivered to fulfill a contract. The mainstream media will point to the total inventory and say, "Look, there are millions of ounces. There's no shortage." They are lying by omission. They are counting the private gold, eligible, that cannot be touched. If you look at the registered category, the actual liquidity, it is plummeting. In the silver market specifically, registered stocks have hit dangerously low levels. We are reaching a point where 1 or 2 large entities, say a solar consortium from Mumbai, could legally stand for delivery of more silver than exists in the registered vaults. How do we know the panic is real? We watch the curve. In a healthy market, the future price is always higher than the spot price. This is called contango. You pay extra for storage and insurance. Recently, we have seen flashes of the opposite, backwardation. This is when the spot price right now is higher than the future price next month. This should be impossible in a commodities market. It defies the laws of economics. It only happens when industry is terrified. It happens when a factory says, "I don't care about the storage cost. I need the metal today. I cannot wait 30 days because I don't believe you will have it in 30 days. When you see gold and silver flip into backwardation, it is the market screaming that the paper promise is losing trust. The market is valuing a bird in the hand infinitely higher than 2 birds in the bush. This is the death rattle of the futures exchange. So what happens when the vault hits zero? What happens when the registered category goes empty, but the traders still hold valid contracts demanding metal? Do the banks go bankrupt? Does the price go to infinity? No. The exchange changes the rules. Hidden in the fine print of the COMEX rulebook is a clause often referred to as force majeure or cash settlement. If the exchange cannot source the physical metal, they are legally allowed to say, "We are sorry, we cannot deliver your gold. Here's a check for the cash equivalent at yesterday's closing price. Have a nice day." This is the ultimate rug pull. Imagine you bought gold insurance against a currency collapse. The currency collapses. You go to claim your gold, and the exchange hands you back the collapsing currency. You don't get the metal, you get the paper you were trying to escape. This is exactly what happened in the nickel market on the LME in 2022. They canceled the trades, They reset the game. The premium flip in Asia is the smart money waking up to this risk. They are paying premium now to get the metal out of the system before the force majeure notice goes up. They know that once the cash settlement order is given, the divergence becomes permanent. The paper price will be fixed at some arbitrary low number. The street price, the real price, will be whatever a desperate buyer in Shanghai is willing to pay, likely double or triple the screen price. So the trap is set. The East is draining the physical. The West is playing with paper leverage. And the bridge between them, the COMEX delivery mechanism, is buckling under the strain. You're standing on a train track and the train is coming. You cannot stop the central banks. You cannot fix the supply chain, but you can choose which side of the force majeure you are standing on. In the final section of this dossier, I'm going to give you the archivist's exit strategy. I'm going to tell you exactly which assets will survive the COMEX break, why you need to avoid unallocated pools, and the one specific type of miner that becomes a kingmaker in a broken market. We have walked through the crime scene. We have seen the Indian retail buyer paying panic premiums. We have seen the Central Bank of India executing the double-barrel strategy to drain the silver market. We have exposed the COMEX break, the mathematical certainty that the paper exchange cannot honor its delivery promises. The diagnosis is terminal. The era of paper gold is ending. The era of physical possession has begun. This brings us to the most dangerous realization of all. Most of you do not actually own any gold. You own a claim. You own a digital promise. You own a row on a spreadsheet at a bank that is leveraging your asset 100 to 1. When the force majeure hits, when the divergence between the spot price and the street price becomes permanent, those promises will be broken. So, what do? How do you survive the great handover? Here is the archivist's exit protocol. These are the 3 specific rules you must follow to ensure you are holding the asset, not the bag. Protocol rule number 1, exit the unallocated pool. If you hold gold in a standard bank account or a pool account or a generic digital gold app, stop. Read the terms of service. In 90% of cases, you are an unsecured creditor. You do not own specific bars of gold sitting on a specific shelf. You own a share of the bank's liability. In a normal market, this is fine. But in a COMEX break scenario where the bank cannot source the metal, they will trigger a bail-in. They will convert your gold holdings into cash or bank equity. You will look at your screen and see a balance of $2,500 per ounce, the frozen paper price. While the real physical market is trading at $5,000, you will be cashed out at the bottom. The solution? You must move to allocated segregated storage. This means the bars have your name on them. They are separated from the bank's assets. Legally, if the vault goes bankrupt, your property is not part of the bankruptcy estate. It is yours. If you cannot hold it in your hand, make sure the law recognizes it as property, not credit. Protocol rule number 2, watch the border. We talked about the western drain. The metal is flowing east. Governments are not blind. They see this happening. Historically, when a government runs out of gold, they do one thing. They confiscate it. Or more likely in 2026, they execute a windfall profits tax or an export ban. If your gold is stored in a vault in London or New York, it is within the reach of the very system that is failing. If the U.S. government decides that gold is a strategic asset, just like they did with the Orinoco minerals, they can freeze it. This is why the smart money is moving metal to Singapore and Dubai. These are neutral jurisdictions. They have no debt crisis. They have no incentive to confiscate. Singapore specifically has built a Fort Knox of the East at Le Freeport. If you have significant holdings, get them out of the Western banking system. Do not let your lifeboat be chained to the Titanic. Protocol rule number 3, the royalty arbitrage. Finally, let's talk about stocks. Some of you want leverage. You want to buy miners, but be careful. In a resource war, the cost of energy explodes. We discussed the diesel shock in our previous dossier. If diesel goes to $8 per gallon, a traditional gold mine gets crushed. Why? Because digging rock out of the ground requires massive amounts of diesel. Their revenue goes up, gold price rises, but their costs go up even faster. Oil price rises, their margins get squeezed. You need to buy the one asset that gets the upside of gold without the downside of diesel, the royalty companies. These companies do not dig holes. They do not drive trucks. They do not pay unions. They simply provide financing to the mine in exchange for a percentage of the gold produced off the top. It is pure revenue. If the price of gold goes to $5,000, they get their share. If the price of diesel triples, they don't care. That is the miner's problem. In a high-inflation, energy-starved world, the royalty company is the kingmaker. They own the cash flow, without the liability. Rotate your GDXJ junior miners into the top-tier royalty names. Let's summarize the new reality. The dip you saw this week was not a correction. It was the final opportunity for the West to hand over its wealth to the East at a discount. India has set the floor with retail premiums. The RBI has cornered the industrial silver market. China has drained the SGE. The paper price in New York is becoming irrelevant. It is a lagging indicator of a dying system. The street price in Asia is the new truth. We are entering a period of bifurcation. There will be a price for paper gold you can't get, and a price for physical gold which you can't afford. The window to move from one to the other is closing. The premiums are rising, the inventory is thinning, and the central banks are not waiting for you to figure it out. They are buying. You should be too. This is Archivist. The protocol is active. Class dismissed.